Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Steve Wyett, Chief Investment Strategist at BOK Financial, and Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss traders' willingness to find an economic narrative that fits their desired outcome. It is great to see the both of you, as always. And Steve Sosnick, I think this is an excellent point to bring up because it feels as if the market's almost in a holding pattern as it tries to digest economic data that's coming in a bit better than expected. And of course, they're really, it's unclear in terms of what's going to happen with the election at this point too.
Jill, I don't know that I wouldn't call it necessarily a holding pattern since we just sort of tend to go up more than we go down. My assertion of us finding the narrative, fitting the data to the narrative goes back to the idea of, a couple of weeks ago, we had the employment numbers, and they certainly flipped us away from this weakness, the soft landing and 50 basis point cuts, to the question of whether or not we get 25 basis points or not. It's about 85% yes on that regard. But the market didn't care, and that one didn't bother me because realistically, I think we want a strong economy. When you and I have discussed this before, when forced to choose between rate cuts and a strong economy, I'll take the strong economy every time. But even now, what we saw last week when the CPI number was a bit disappointing, coming in a bit higher than anticipated, and annualizing, over a 3-month period to a bit over 3% instead of the 2 handle. Market said, you know what? Well, some of the weekly jobless claims are a little higher than expected. There's kind of the offset, the economic weakness. The Fed's not going to change course, despite the fact that almost all the economists I spoke to, my colleague Jose Torres here at Interactive Brokers being one of them, believes the weekly jobless claims were inflated because of temporary factors relating to Hurricane Helene in North Carolina and, dock strike, Boeing strike, et cetera. So this is what I mean, where the market will just sort of fit the narrative, fit the data to its preferred narrative, which is things are good, we're going up. And, on a day like today where there's really no interference from the bond market or it's Newton's first law, what a body in motion tends to stay in motion.
Yeah. And Steve Wyett, that's a good point that Steve brings up. And I guess holding pattern perhaps wasn't the best descriptor of that. I guess perhaps I thought there would have been more volatility in the month of October. And granted, we're only literally halfway through. But it seems to be digesting news a bit better than you would seasonally expect from an October.
Yeah, I think, look, Steve's exactly right. It's kind of pick your number that you want to build the case that you want to see going forward. I think the Fed's kind of in an interesting spot here, though, Jill. When they didn't ease in July, and then we got a string of weaker than expected economic numbers that got some people thinking they were a little bit behind the weakening in the employment data or something like that. So they come in with 50 basis points. And since that time, almost every economic data has been stronger than what we were looking for, particularly, and Steve points out the CPI number being a little bit stronger. But even in the employment data, the last 2 months, average hourly earnings have been about 1/10% hotter than what we were expected going in there. So, look, I think there's a reason why the yield curve is kind of changing shape a little bit here. Rates have floated up a little bit since the Fed actually cut 50 basis points. But to Steve's point, if the economy is going to be better and earnings expectations are going to stay where they are, and we're just getting started in the fourth quarter or the third quarter earnings season, and you look at what's been performing as an employee of a diversified financial services firm, I'm not upset about seeing financials acting a lot better in the market these days. It's not the tech, it's not some of the stuff that's been leading. It's broadening out a little bit. Small caps are starting to catch a little bit of a bid here. So this is the market's just looking at the overall mosaic, and I think the bottom line is the Fed still wants to lower interest rates. Despite what may be a little bit troublesome inflation numbers. And I think here's the hard part, and I don't know if Steve would agree with this, but we may have gotten some early indications from Hurricane Helene and Milton, but it looks like the next couple of months' numbers could really be messed up from some of that data going forward as well. And so it might just be that period where it's going to be hard to tell exactly what's going on with some of the numbers. That might put the election right at the forefront. Is what we're less than 30 days away from that now.
Yeah. And Steve, any
Just if
follow-up
I
thoughts to
could,
that?
yeah, if I could follow up on that, I do think, everybody's going to be focused on the election, to be sure. But I do think that that's going to provide, to your point, Steve, I think that I agree that it will provide some difficulty for a data-dependent Fed, because how do you sort out what's temporary and
Yeah.
weather related? And I know weather related, is always like that's a great cop out when a company does it for earnings, but when an economy does it because of natural disasters, it's a very different thing. And so I don't know how you parse that out. There's a lot of stuff that has to be reckoned with here. And so the market has been ahead of the Fed all along in terms of hoping for more cuts than the Fed was willing to deliver. I think 25 is sort of in the cards. My guess is the Fed is unwilling to upend that notion without solid data in either direction. And I think that the cloudiness that you talk about from the disasters
Right.
probably biases them more toward staying at 25, just because they can't necessarily make a case for anything else.
Yeah,
No,
it's interesting. Sorry, Steve, I just one moment here. When you think about
Mhm.
the weather impact, and my first thought went to, okay, well, how are the retailers going to digest this, right? And translate that into the strength of the consumer, because weather-related issues are always part of the earnings narrative there, right? And then you also have these prime days, whether it's Amazon, Walmart, or other big box retailers that do these special holidays, which seem to happen every few months now versus the 6 weeks leading up into the Christmas and New Year's holiday. It's almost like those year-over-year comps, it's making it more difficult to be able to discern what that strength looks like, because the calendar keeps shifting. And then, of course, you throw in the hurricane season around that too.
Yeah, and of course that's look, that's the issue with a growing economy, right? The numbers have to keep getting bigger as we move forward. Look, I think that part of this is as tragic as the hurricanes are, in the scope of the overall economy, it's not so large that you think it's going to have that an outsized impact on the economy going forward. And in the end, we're going to recover from that, and things are going to move forward. I'd like to get back to Steve's kind of point, though. Look, and Jill, kind of you talking about this holding pattern that we're in. We have seen the VIX, the equity VIX, is traded up, but you look at other stuff like credit spreads, they just remain really narrow here. So I think there has been somewhat of a desire to see buy some protection against this seasonal volatility that you talk about, Jill. We haven't seen it to this point, but if you just look at the longer term on what the bigger picture is from credit spreads and that type of thing, man, what are we looking at? GDP for the third quarter at 3 to 3.2%. Both the Atlanta Fed and the New York Fed model over 3%. So it's just hard to get too worried, if you will, about the economy as we think we're going into the end of the year.
So to your point about the VIX, Steve,
Mhm.
part of it is this is normal ahead of an election.
Sure.
There's been sort of a kink in implied volatilities, the VIX futures curve, et cetera, around this period, because we have it's reasonable to expect there'll be volatility. I mean, it's quite possible that even by the next Fed meeting, that we may not know who the next president is, or the composition of Congress. Also, though, to speak to the volatility, we have had some. A lot of it is what Jill's used to me saying, socially acceptable volatility, where we like the up days. But these days where we move, last couple of weeks we've had up nearly 1%, down nearly 1%, up nearly 1%. That's volatility. The fact that it's tended to move forward is something the markets like. But if strictly from an option pricing point of view, you have to price in the fact that if you have indices capable of moving 1% or more a day, that's going to yield you a VIX that's closer to 20. That's just how it tends to work out.
Well, I guess that's why you also want to be careful not to make the narrative fit your investment thesis without being able to be flexible, because this action is not necessarily a bad thing. It probably is more reflective of a normal market, if you will, when you have some of these events that are on the horizon as the market continues to climb this wall of of worry here. And to your point, Steve Sosnick, we might, the next Fed meeting is the day after the election. And, if last election cycle was any guide, we're not quite sure what that transfer of power could potentially look like. And then, of course, you have companies coming into year end, not understanding what, tax policy could potentially look like. How do you set budgets? What does that mean for employment, R&D? Those are big factors for companies to be able to set their longer term strategies, Steve Wyett.
No doubt about it, Jill. And if you just look at the differences in the platforms, there's some pretty big differences in those platforms on issues like taxes and immigration and energy that could make big shifts in how the economy and the markets, what parts of the markets are positive as we move forward. So I think the one area though, and this is where I'm going to come back to the bond market, being a bond guy, and I just thinking about how the bond market's really been acting, which it's been a little less volatile, if you will, than equities, but just more trending upwards in yield. The one area of agreement looks like is that no matter which presidential administration is elected, the deficit's not going to get any better and probably will get worse. And so we're looking at a forecast from the Congressional Budget Office of ongoing budget deficits of $1.8 to $2 trillion. And if there's risk to that number, Jill, it could be that they're higher than that. And so this is where I think this isn't going to happen overnight, and it's not a crisis now. And it's kind of one of these things you want to be a little careful about crying wolf too often. But we're not looking at becoming more sustainable on our fiscal path on a go-forward basis. Both candidates are out there now. Man, they are passing out tax cuts like candy on every part of the economy out there. They're really working hard to get votes in every corner out there. But the fiscal reality of what that actually means is not particularly additive, we think, to the outlook from a longer-term fiscal standpoint.
Yeah, you have to ask yourself just how sustainable that is in the longer term, because we're not fixing issues that already exist, right? Like getting that fiscal book in order, if you will, and then you're just adding on more programs. And then when you have tax cuts is a promise to your campaign, this money has to come from somewhere. So what we're hearing on the campaign trail might not necessarily translate into anything tangible at the end of the day. And then, of course, not to sound flippant, it's not necessarily the person who's in the seat, but it's really the composition of who's governing and what the legislative body looks like, because that's really where policy is formulated, Steve Sosnick.
That's a coin flip, Jill. No, nobody knows how that's going to shake out either. I mean, you can make a plausible case for pretty much any situation. You figure there's, the House is 50-50, the Senate's 50-50, the presidential race essentially 50-50. Yeah, at any given moment, they're 52-48 or 53-47, that kind of thing. But realistically, they're all coin flips. And so do you see a situation where it's all heads or all tails? That's kind of hard to do. So as a result, you probably end up with some sort of split and therefore some sort of, some sort of governor on the whole process, which the markets tend to prefer. Markets do tend to prefer, some sort of split government. And I do think, a lot of it right now, to Steve's point, is just, saying what people want to hear. And I can't imagine a lot of these things come to fruition. So realism probably prevails in the end. The one question you get would be, if I had to do an election, bet right now, it would be if it comes up all R's, I think you get people expecting the potential for a tax cut, but then potentially also you're going to really see the bond market. I think the bond market gets very fearful, particularly because so many bonds are held by foreign investors. I think they are not particularly in love with that idea. The flip side is if you come up all D's, I think people would start to assume that at least the Trump tax cuts would be, if not, they'd be meaningfully changed. And that you could get some people who normally might wait to take some capital gains till after the calendar year ends. They may want to accelerate that if they're afraid that capital gains taxes may go up or something, or their tax brackets may go up. So there's a lot of moving parts here. Odds are it's probably not going to, one party is probably not going to run the table or the other, but which is also why I think you don't see a ton of specific electoral bets being placed, via the stock market. Rather, instead, you sort of see this volatility, the volatility pricing that in.
Yeah, and those are all great points. And Steve Wyett, to wrap up here, I mean, next time the three of us meet, we should have a result, well, for all intents and purposes.
Yeah, hopefully we do have. I mean, look, it's the risk, or I don't want to say it's the risk, the opportunity, both the risks and the opportunities are really high for us as we move forward out there, Jill. Steve's right. This is probably, we're a 50-50 country when you get right down to it. And so the idea that anybody's going to get a mandate type of a vote probably is not out there. But it's it's something that I think investors don't change your plan. That's not what we're saying. And I think that's kind of where Steve is. Nobody's making really big bets. That would be purely speculation at this point. But I do think we need to be aware, kind of how I'm putting it to my audiences when I present it these days, Jill. I think every one of us needs to be prepared to be part of the solution as we move forward. I don't know exactly what that's going to look like, but we're all going to be part of the solution.
All right, and we'll end that on a positive note. Appreciate your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq.